Welcome to The Explainer. Today, we're going to follow the story of a young entrepreneur named Ram and demystify what many people call the language of business, accounting. It's a really cool journey from total confusion to complete confidence, one number at a time.
So let's jump right in with this question. How does a little stationery shop, or any small business for that matter, learn to tell its financial story? We're going to see exactly how Ram figured this out and how he went from just, writing down numbers to actually understanding what they meant. So let's start at the beginning with Ram. He's a new business owner. His stationery shop is doing pretty well, but that growth created a whole new problem, a big, foggy mess of financial confusion.
At first, Ram thought accounting was simple, right? Just jot down what you sell, jot down what you spend. But pretty soon, he hit a wall. He couldn't answer the most basic questions. Was he actually making any money? What was his business even worth? He had no idea. He realized he needed a real system to see if his business was healthy or not.
And this is where things start to click for him. This is Ram's aha moment, where he learns this one simple, unbreakable rule that just brings order to all that financial chaos.
First things first, Ram had to get a handle on assets. Basically, assets are all the valuable things his business owns. We're talking about the cash in the drawer, the money in the bank account, and yeah, all the pens, notebooks, and inventory sitting on the shelves. It's all the stuff the business has.
Okay, next up, liabilities. If assets are what you have, liabilities are what you owe. These are the debts the business has to pay back to someone else. For Ram, the big one was a 200,000 rupee loan he got from the bank to get up and running.
And the third piece of the puzzle is capital. This is the owner's skin in the game. It's the personal money they invest in the business. In this case, it was the 500,000 rupees from Ram's own savings that he used to kickstart the whole thing.
And here is where it all comes together in this one beautiful, simple formula, the accounting equation. It's just so logical when you think about it. Everything the business owns, its assets, had to come from somewhere, right? It was either funded by money from others, the liabilities, or it was funded by the owner's own money, the capital. It has to balance. It always has to balance.
Now, this next part is huge. It's a rule Ram absolutely had to learn, called the business entity concept. You have to treat the business like it's its own person, financially speaking. The money in the store's cash register is not Ram's personal coffee money. You have to keep business and personal finances totally separate. It's fundamental. Okay, so you've got this beautiful, balanced equation. But what happens when you actually do business, when money moves around? Well, Ram was introduced to this incredibly elegant system that makes sure the books always stay balanced, no matter what.
This is the heart and soul of accounting, the double entry system. Honestly, you can think of it like Newton's third law, but for money. For every action, there's an equal and opposite reaction. Every single financial thing that happens has two effects, not one, two.
All right, let's see how this actually works. Let's take a super common expense for any business. Ram pays his monthly shop rent. It's 15,000 rupees, and he pays it in cash. See what happened there? Two things. Effect one, the business's cash, which is an asset, went down by 15,000. But at the exact same time, effect two happened. The amount recorded under rent expense went up by 15,000. So one account goes down, another goes up by the same amount, and the whole equation stays perfectly in balance. It's beautiful. Now, to make sure this system is telling the truth, Ram had to learn a few more key rules. We already talked about the business entity concept, keeping things separate. But there's also the accrual concept, which just means you record an expense when it happens, not necessarily when the cash leaves your hand. And the matching concept helps you line up your expenses with the sales they helped you get, which gives you a way truer picture of your profit. All right, we've got the equation, we've got the rules. Now let's build the actual process. This is how Ram learned to follow the story of every single rupee, from the moment a customer pays to the final check at the end of the month. So, Ram learned this really neat three-step flow. And honestly, the best way to think about it is this. You've got a diary, then a filing cabinet, and then a final check to make sure you did it all right. Let's break that down.
Step 1. The journal. This is literally the business's diary. Every single transaction, every pen sold, every bill paid, gets written down here first in the order it happened. That way, nothing ever gets missed or forgotten.
Okay, so you've written everything down in your diary, but you can't just leave it as a long, messy list, right? That's where the ledger comes in. The ledger is the filing cabinet.
You take every entry from the diary and sort it into the right folder. All the cash stuff goes in the cash folder, all the sales go in the sales folder, and so on. Now Ram can just open a folder and see the total for any category in a second.
So Ram has done all the hard work. He's recorded everything in his diary, he's filed it all away nice and neat, and now it's time for the big reveal. This is where all those numbers finally turn into real knowledge.
And this is it, the trial balance. It's basically a master list showing the final balance of every single folder in his filing cabinet. You can see his cash, his bank balance, how much he's sold, and even what he still owes his supplier, Hari Traders, or for the electricity bill. It's all laid out in those two columns, debits and credits.
And here it is, the magic moment. He adds up that left column, the debits. Then he adds up the right column, the credits. And boom, they match perfectly. 605,000 rupees. This is the moment he knows that the system worked, that the arithmetic is solid, the books are balanced.
So you see, for Ram, this was a total game changer. This process took what was just a messy pile of receipts and numbers and turned it into powerful knowledge. He went from being completely in the dark, just guessing about his business, to having this crystal clear picture that let him make smart, informed decisions.
But here's the kicker, and this is what you should really take away from Ram's story. Accounting gives you the structure to understand your business. But just because the books are balanced doesn't mean the business is profitable. That's the next question Ram had to answer. But that's a story for another time.